Alright, we are live. So we're going to see how to analyze financial time series data using Python. I'm going to take you through the steps that you can use in order to analyze financial time series. Alright, so we'll be uh, doing this analysis using Python, and I'm going to take a data set. Well, if you want the data set, you can just give me just message me in the chat box. Yeah, so if you want the data set, please message me in the chat box. I'm going to send you the data set. So in order to do this analysis, we're going to be first importing some of the very important Python libraries. Well, for data analysis, some of the most important Python libraries are like Matplotlib, NumPy, Pandas. So Matplotlib is for plotting, for visualization, data visualization. NumPy and Pandas can be used for data handling, summarizing data, splitting data into different parts, and things like that. So very useful libraries. Seaborn is another library which can be used for data visualization. And then I've also imported some other libraries from stats model. So stats model a package is basically dedicated to doing statistical analysis, and from there I'm using the TSA, that means it's time series analysis. And then in particular I'm importing the exponential smoothing and simple exponential smoothing. I'm going to tell you why I'm importing only these two, but you can also import many other packages from the stats model, from stats model. So these are some of the basic libraries. We're going to first import, and then so we'll first define a working directory, and that's something we've done, and I've already done that. So it's basically okay, so I'm going to first import the data set. So how I'm going to do it is by using pandas. So it's read underscore excel. So I'm importing the index price data. It's a time series data. So what I mean by time series data is that you have data point for a continuous time period, and I've taken data point for a full 1 year. It starts from 1st of January 2003 to 2nd of January 2004. Alright, so it's index data, and I've got two variables. One is prices, the other one is returns. Okay, and how I've calculated returns is just basically is a logarithmic return. You can use a very simple formula to calculate return from prices, and our focus will be primarily on prices, but we'll also do a bit of analysis on the returns. Okay, so first we'll see if we have nulls in a data set. I'm going to use isNull function to see if I've got null values. There's no null value here. As you see, it returns basically false. And then I'm going to do I'll get the basic summary statistics of the time series. In time series analysis, summary statistic is equally important as is important in cross-section data analysis or in panel data analysis. Oftentimes we ignore this, but it's very important. So why it is important is basically to understand where the data is centered around. So you will see the central tendency of your data set, which is mean or standard deviation, and then it gives you a brief idea about where the data is centered around. Alright, and then I'm going to first plot the data. It's a line plot, and how we're going to plot prices is by using the matplotlib. So we have imported matplotlib, and so basically then we will plot it, and the way it looks like that, initially there is a drop in the price and then it suddenly goes up, right? So this is a typical pattern of stock index, where you see some sort of volatility. I've taken the stock index from a developing market, from an emerging market, where you see quite some volatility, and that's what you see here. So second half of year has been very good. There is a significant jump in the price, in the index price, as you can see in this plot. Alright, so you cannot infer anything from it just by looking at the trend graph, primarily because of two main reasons. First, it's only for 1 year period, right? So in order to get a better sense of the data, you got to have more data, right? It sounds like there is a huge shift in the prices, but that's not true actually. If you take a couple of years more, like 4 to 5 years of data, then the visual plot will appears like, okay, there is some volatility, there is some jump, but it's not like a significant jump. But so that's one aspect you should be you should be focusing on, that it's not just the visual plot that you should look at. You should also look at the different other aspects. For example, you should understand this with respect to the summary statistic that we just got before, right? We have the maximum, minimum, and the quantile plot, and so on. So there is definitely some variation, but it is not it is not as big as the plot tells us, right? The plot tells us like there is significant variation, but that's not true, right? As you can see, I mean, there is some variation from 1000 units to 1400, and the maximum is 1900, right? There is 80-90% of the shift from the minimum to the maximum, but the plot suggests that there's a 3 to 4 times of shift. That's not happening here. Alright, so how does the return looks like? It's a daily return, and you expect that to be hovering around 0%, because sometimes we have positive return, sometimes we have negative return, and that's what you can see here. Alright, you expect the return series to be white noise. And what is white noise? Well, white noise is basically where you expect your time series to be it's like very volatile around 0%. That means your mean is 0, and mean is 0, and standard deviation is constant. Obviously standard deviation is not constant, but it is definitely hovering around 0%, something that you expect in the return series, right? And return is way more volatile in the prices, and that's what you can see. And especially in the emerging market, you can expect the return to be quite volatile, which is what is happening here, by the way, right? And it is conforming to the economic theory that prices and returns in the emerging market is always volatile. And then you can also plot return and prices side by side. It's the same plot. I'm just plotting it again side by side just to get a better visualization. And then you can also use dotted plot. This is what I've also used here, right? The syntax remains the same, except the fact that I'm using here style equal to k. So basically it's going to give us the dotted plot instead of a line plot. And that's what you see here. Yeah, I've done that for both the prices and the returns. Oftentimes we do not look at the histogram or the kernel density of time series data, but as I said, yeah, descriptive statistics is very important. So is histogram and kernel density plot of the time series. And how we can do is that using the hist function, and as you can see that for most part of the year, the stock index was around 1000 to 1200, and only for a small part of the year it changed significantly from there. So that's something not very evident from the visual plot, the line plot that we saw, right? On the other hand, so by the way, prices you see here is not following a normal distribution. It's right orthotic, uh, whereas returns seem to be similar to a normal distribution, although it's not purely normal, but there's some level of similarity to normal distribution. And then we will plot the kernel density. Kernel density is a smooth version of histogram, and you see here both prices and for return we have kernel densities. Yeah, as expected, you see right orthotic for the prices and somewhat similar to normal distribution for the returns, right? And yeah, it return is not normal actually, as you see here. It seems to be very log normal. uh, yeah, in finance, log normality is used more often than normality. Asset prices very famously follow log normal distribution than normal distribution. So it's something that yeah, it's slightly different from standard normal a normal distribution, but similar. And then we will plot the moving average or the rolling mean. And rolling mean, actually what it does is that it actually smooths the distribution of the data, right? It's yeah, basically there are some local volatility. That means volatility happening within a very small time period range. We're not interested in that. Sometimes what we are interested in is that what exactly is more or less the mean value of the stock index in that local period. And how we get to know that is by plotting the rolling mean. Okay. So here we have plotted the rolling mean with taking 20 data points at a time, and as you can see here, it is smoother compared to the one that we got first, right? Here you can see it is much more volatile, guys, right? It's volatile at a given period, right? At a yeah, if you see this, it's much more volatile. But if you plot the rolling mean, it's much smoother now. Similarly, I've also plotted the rolling mean for returns, but rolling mean for prices is more important than returns actually. Yeah. Then exponential smoothing. Well, with the rolling mean, the thing is that you give equal importance to all the preceding observation or historical observations of the time series, and that's not a good thing actually, because the nearer observations are more important than the farther ones, right? Because YT, for example, YTs or time series, YT can be predicted in a better way than using YT minus 1 compared to YT minus 2, and then YT minus 2 is better than YT minus 3, and so on. So the nearer observations are more important, and that's exactly the idea behind using exponential smoothing, where you give higher weight when you are smoothing your curve to the nearer time series observations. And yeah, from the stats model we have got the simple exponential smoothing, and then yeah, the smoothing parameter that you have to use. I've used 0.1. It can vary, that you can definitely vary it, as in how smooth you want. And then yeah, what I've done is I've plotted both the initial time series, that means the original one, and the smooth one. The one that you can see here, the red one, is the original time series. Okay, the one that we plotted first, right? And then the blue one is the smooth version. Okay, and as you see, the smooth version is much less volatile, right? And why it is important? Because if somebody asks you what is the average price you saw in September 2003, what is the average price? Okay, an approximate price of the index. Well, instead of using the original time series, you should use the smooth version of the time series, because the original time series is so volatile in the local period that it's less accurate in sense. Whereas if you use exponential time series, a smooth one, you are actually averaging the little bit of shocks, the economic shocks that is making the series volatile. You're giving a more approximate so approximate value uh, of the stock price at a given point, and that is very useful information, because then you remove the temporary shocks, right? So the temporary shocks is something that we are getting rid of by using smoothing techniques, and here we are using the exponential smoothing. Exponential smoothing can very well be used to forecast time series also, right? So here I have just fitted it to the historical data, but the same algorithm can also be used to forecast for the next 12 months. Okay, but exponential time series is somewhat okay to forecast for a short-term forecast, right? Like for next 3 months or next 6 months or 12 months. But if you want a long-term forecast, I think exponential time series is not that great a model. You have to use something like ARIMA, that kind of a model. Okay, but it can certainly be used. Okay, it's not theoretically that sound compared to ARIMA, but it's much easier to build, right? You do not have to do much. It's just by using some basic parameters you have to select, and then it will automatically forecast for you. So if you have like a lot of time series to forecast in a short time with a reasonable accuracy, I think exponential time series is a pretty okay model, right? And it's heavily used in many industries. uh, Very less popular in academia, but useful in industry, because in industry we do not really care much about the theoretical aspects of the model. We are more concerned about the practical aspects, and from a practical aspects point of view, I think exponential smoothing is quite good a model. All right, then what we'll do is that we'll plot something called a a lag plot, sorry. Okay, so a lag plot is used if you want to check if the series is random or not. Okay, and why is that important? Because if the series is random, it's very difficult to forecast its future values, because you cannot simply predict future values of a series if the values are random, right? So it simply does not make sense to build a model for a random time series data. And for that, we need to first know if there exists some level of pattern. So in order to know the pattern, you need to check what is known as the lag plot. So from pandas, we are importing a lag underscore plot. Okay, and we are using the lag plot underscore plot function to get the lag plot for the prices. And yeah, the thumb rule here is that if the plot looks very linear, okay, then there exists some pattern. If does not look linear, then there is no pattern. That means you simply cannot build a forecasting model using this data. That's what it means basically, right? But as you can see here, the pattern looks pretty linear, right? Therefore, is it has got some pattern, and it's a linear pattern, so you can definitely go ahead and build a theoretically sound model like AR or MA or ARIMA. That kind of a model you can certainly build using this data. As you see, there is definitely a trend, right? It's like you have seen that line plot or dotted plot previously. There is a trend. That means it's not a stationary it's not a stationary time series, so we have to first make it stationary before building a model, but that's part of your building an ARIMA model, right? And then the next thing that we're going to see is that we will plot an autocorrelation plot. Okay, it's also known as the ACF plot. Well, ACF plot is very important to also know if there exists some level of pattern in the data or not, or is just it's just random. That means the current time series cannot be predicted using its historical or past data points, right? So to confirm that, we can also use autocorrelation plot, but autocorrelation plot is also used for other purposes, right? It's used to find out the order of the autoregressive part of the ARIMA model, which is the AR part, right? If you're familiar with ARIMA, so you need to first know what is the order of the AR part, autoregressive part, then order of the MA part, that means moving average part, and also the order of the integration, that means how many times you have to difference the series in order to make it stationary, right? So here so the plot basically says that to how many lags the time series is related. That means it has some relations to its lags. It could be just 1 lag, 2 lag, 5 lags, 10 lags, and so on, right? Here you see that it has relationship up to even 50 lakhs. Of course, a lot of it is not useful, it's pointless to build a model with taking 50 lakhs, but most of the information is captured in the first 2 or 3 lakhs, and that we can explore as we build a time series model. And the next thing that we're going to see is that partial autocorrelation plot. It's very similar to autocorrelation plot, but there is a subtle difference here, that you take out the intermediate lags between and see how, let's say yt is a time series, how is it related to yt minus k, where you take out the k lags, the k intermediate lags. Okay, and that is important to in order to know the order of the MA part of the time series, that is the moving average part of the time series, right? So so that's something that you get to know. You have a confidence level here, right, the dotted plot, and see to what extent you have the pattern, and it seems that only it has relationship only with the first one, and here we have used a lag of 5. Okay, and you can change that also, right? You can change that and see to so what's the optimal order of the MA part, and then the order of the P, Q, and I, right? I is basically your integration, P is the order of the AR part, and Q is the order of the MA part. That you can find out also by looking at the AIC values and optimally build a model where you have the Akai key information criteria, AIC is the lowest, right, or BIC, right? So is something that you can look at, and you can build multiple models with different combination of P, Q, and I, and select the one that has the lowest Akai key information criteria, right? Or what is known as the parsimony, model parsimony. That means with less number of parameters we are able to predict reasonably well, right? That's what Akai key information criteria is useful for, right? You can use that to optimally to optimize your model selection, and that's what you can do. So these are some of the things that you can explore on the time series data before building any theoretical model, be it predicting its future values, or creating scenarios for its future values, for all kinds of things, or predicting volatility, right? In time series we're interested in two things. One is the mean value of the time series, and second one is the volatility part, or the standard deviation part, right? And both are equally important. For the mean prediction, we use the autoregressive models, the moving average models, or the ARIMA models. For prediction of the standard deviation or the volatility or the variance, whatever you call it, we use models like ARCH or GARCH, GGARCH, EGARCH. These are some of the volatility forecasting model, time series models that we use to forecast the volatility. And both are important if you really interested to get a to know how the price or the return, whatever time series it is going to behave in future. So if you are an investor, or you are doing some kind of analysis on financial data, it is extremely important therefore to explore the data first, to have some basic idea like how we have explored, and then zero in on a given model. If you're not concerned too much about the like the long term analysis, you just want the very next period what is going to be the price, just fit an exponential smoothing model, the one that we just saw, right? That will do the job. But if you are really interested for a somewhat longer term, so you should focus both the mean of the time series using ARIMA and the volatility part using ARCH and CATCH. So that's it for today. In another session, I'm going to take another time series data. We'll build ARIMA. We'll also build GART, GGARTs, and so on. So in these live sessions, I'm going to do most of the things on the financial data analysis, taking stock market, macroeconomic data, stock market data, derivative data. So all kinds of financial data I'm going to take and analyze, and I'm going to do these live sessions. Most of it will involve doing data analysis using Python. If you have some suggestions, please message me. Drop me a message. Just you can message me in the chat box, or you can also comment in any of our video, or you can also directly email us. Thank you so much, and I wish a very good day.